Assalamu alaikum. Hello, everyone. It's great to see all of you here. And thank you for joining us. This is Abdullah Al-Amri, part of the investment team at Jada Fund of Funds. I will be moderating this webinar. If you have any questions or comments, please send them in the Q&A box, and we'll try to answer them at the end of our discussion. We have with us today Khalid Talhouni, Managing Partner at NOAA. NOAA Capital is an investment platform that focuses in the MENA region, and they invest through their venture capital fund and also their venture debt fund. We have also Shane, the founding partner at Shuruk Partners. Shuruk is an early stage venture capital fund investing in the region. They like to refer to themselves as founders partners. And last but not least, Sunil, he's the co-founder and general partner at Venture Souk. Venture Souk is a MENA-based venture capital firm with a global portfolio and teams in UAE, Saudi Arabia, and Egypt. In 2020, Venture Souk launched the first fintech-focused fund in the region. So today with our esteemed panelists, we'll discuss the global market conditions and the changes from a macroeconomic perspective and the impact of these changes in the private market, more specifically the local venture capital market, for fund managers and of course for startups in terms of valuation, fundraising, and so on. At the end, we'll hear from our speakers the lesson learned from the previous pandemic and also recommendations for founders to get through these conditions. So now we have seen inflation and interest rates are rising. Public markets got impacted, especially the tech industry valuation. I'm sure we have the different point of view about the current unexpected market conditions between optimists and pessimists. So we would like to hear our panelists' views on the global market climate and the changes we see, starting with you, Sunil.
Thank you, Abdullah, and glad to be here. I guess it's a fairly broad question, but on everyone's mind these days. If we go back, coming off the global financial crisis, of course, governments around the world were aggressive about keeping interest rates low to kind of continue growth, and that carried through for at least the last decade, and that led to kind of an increase in asset prices, of course, and was great for venture capital, as asset allocators were looking for yield and were willing to take on more risk, and invest and really deploy significant amounts of capital into VC, which was considered a riskier asset class as compared to other alternatives. The corollary of that, of course, has been inflation, which is really kind of hit Main Street now as we see gas prices go up, groceries all over the world, and real people are really starting to kind of experience this, outside of the world of finance. And so now, governments have reacted quite aggressively with interest rate increases in order to slow down inflation. But of course, the impact, the side effect of that is, of course, slowing down the economy, and asset allocators, of course, will now look potentially to other asset classes where they can get yield in a less risky way, and I guess theoretically less capital will potentially go to venture capital managers, which the trickle down effect of that is again, theoretically speaking, less capital going to founders. Now I think I'm not an economist, and I think, speaking fairly transparently, most of the people in our world right now in these vintages haven't dealt with a high inflation, a high interest rate environment. We're probably a little bit too young to have experienced that, and at least in our professional careers. So a lot of this is theory, but we're not there yet, because we know that most global venture capital funds, all of us, raised significant amounts of capital in kind of 2020 and 2021. So it's not like that has happened yet, where VCs, venture capital firms themselves, are starting to receive less capital to deploy. So it's hard to say. I think what's happened, at least now, and maybe this is the first stage of it, is investor confidence has fallen off a cliff, obviously, to put it bluntly, and we've seen that in the public markets, and we've started to see that in terms of a slowdown in venture capital deployment into founders. But I think that a lot of that is kind of how a lot of that is emotional, as opposed to kind of the availability of capital, because we know that we know that venture capital firms, particularly large ones, tier one US and global VCs, have a ton of capital. They're just kind of pulling back. This has almost been the impetus for them to say, okay, well, let's start to think about all the checks we wrote in the last 3 years and start to kind of see where those companies are. But I do think we're already witnessing a slowdown in deployment and to actual founders and companies, and that's going to continue for the foreseeable future, until at least in people's minds the global economy looks like it's back on track.
Thank you, Sunil. Shane?
So, as Sanil mentioned, look, it's not a rocket science to understand what's going on globally, right? Many people have been burned like a crazy amount. We're talking about billions and billions of dollars, and many people are taking it very cautiously. And I believe that's the right, prudent thing to do. But to really tie this back to the region and what we do on a daily basis, and I think to really the audience here, right? We just need to come back to the fundamentals, meaning that the last 14 years of the bull market, which is honestly one of the largest and most at a crazy pace in human history, I think we just need to recalibrate our frame of reference. Don't if you don't have to raise like a $50 million, $100 million, don't go and do it just for the sake of, I want to be the biggest guy. If you don't have to burn $2 million, $3 million, like the way many US tech companies, they did it. There's like the reason many US public companies actually have been falling 50 to 90% of their market cap is not because they're a terrible company. It was just they were burning too much unhealthily to get to the level where they could get there over time, but they just were burning every single fuel to get there. Right. So like right now is a good time to just recalibrate, put as a new reference, and then just to build the business on a fundamental way. If you can do that, there's, as Sanil mentioned, the truth is, guys, that there is enough capital outside. There is enough liquidity in the region and globally, but just for the right companies. When just a few months ago, frankly, there was just being a lot of spread and prey to many companies, but now investors are a lot more cautious, and that does, of course, affect the valuation. That does, of course, affect the valuation across the whole late stage and the early stage.
Khalid, we were talking about the global changes that we see from the macroeconomic perspective, and would like to get your view on the changes we see.
Yeah, sure. Sorry, I dropped out. Internet
Okay.
issues on my side.
It's okay.
Yeah, so I think the key takeaway is for us is that basically, like, obviously without going back into rehashing a lot of what you've seen elsewhere and heard elsewhere about, like, quantitative easing and the availability of a lot of easy cash propping up valuations globally. What we think is going to happen is that there'll be a slow trickling effect of valuations compressing regionally, similar to what's happening in private and public markets elsewhere in the world. Typically, the region, if you look at the last two major crises, and if something to learn from history, it could be different this time, but if we were to kind of extrapolate from past experiences, is that these type of economic dislocations hit our region on a lag, a 3-month lag, 6-month lag, 8-month lag, something like that. So we'll start to see, I think, a lot of more compression in valuations. We're already seeing that in a big way with companies. So we already kind of are beginning to see, even in our region, specifically at later stages, so Series B and above, where the companies that would have raised at a very different and much higher multiple 8 months ago are raising at 50% of that multiple today. And I think, as Shane was saying, that's generally healthy. I think there's a lot of fragmentation in the market. I think it might force a lot of rethinking of not just building sustainable businesses on a unit economics basis, but also to really think about funding business models that are in of themselves viable and effective and important, and taking venture capital back to that kind of essential question, which is we want to help founders address big problems rather than just kind of marginal problems. And with the availability of so much cash that was in the system, like the 3, 4, 5 years, in the past 3 to 5 years, I think you see a lot of, not enough of capital going towards addressing like the big questions, the big problems, and more around kind of like more marginal problems.
Thank you, Khaled. I think all of you agreed at the same point that this is, I would say, a healthy market correction. But speaking of that, we saw Klarna. Klarna is basically a buy now, pay later company, one of the giants in the world, and they are trying to raise their recent round at a massive discount. I think 85% down from last year. They were around 45 billion, and now they're 6. So do you consider this a healthy correction, or is this or was it overvalued? Yeah, I mean, how should we blame the public market or the VC fund manager?
I think all of us, right? So I actually did, like we as a Shuruk team, we did go through their latest earnings transcript and whatnot. If you look at their default rate, like it's actually skyrocketing, right? And if you look at a lot of their fundamentals, I think what we really need to say as a group is, everyone, guys, the $60 billion is no joke. It's a crazy amount of money. I think sometimes if we're in this industry, it's so easy to say $1 billion, $10 billion, like 50 billion, like Coinbase 100 billion. Like if you think about the magnitude of those, right? We really need to question what's the valuation multiple. If you was at $60 billion market cap, if you looked at the multiple, frankly, many people will argue it never made sense. It never made sense. That's why even public company investors were coming to the private market, because they saw that they cannot make a good returns by investing in public market, right? And then all that, of course, created even more bubble. So I'm not here to say that 6 billion is a fair value. I think that will piss a lot of my friends in the US and a lot of guys. However, I can argue that the 60 billion perhaps was too high, right? And for many companies, not only in BNPL, for almost every, listen, what I call like a growth at all cost tech companies globally, right? Who are just fueling the growth.
Yeah, I mean, just to add to that, I think like, we kind of forget that, valuation is a function of two things, right? What capital is prepared to pay for equity today, and then what supply of capital is available. But then that is also in of itself a function of like future cash flow. So when you buy into equity into some business today, you're really buying whatever that cash flow is generating for you in the future over some period of time, or whether that's 10 years or 20 years, etc. So I think a lot of people had lost sight of that fact, especially in an environment where the cost of capital is so low or zero, basically. And because of that, like, those kind of today's multiples didn't reflect necessarily what the future discounted cash flow of a company might be, given that everyone there was kind of some inbuilt assumption that the cost of capital will remain extremely low at zero, or the real cost of capital is actually negative. So I think that's kind of was built into the system. The minute that environment starts changing, as Shane mentioned, then like those numbers become crazy. I mean, how does Klarna? I don't know the specific numbers of Klarna or the latest numbers there, but how does it become a $60 billion company? It means like, it has to throw off a lot of cash and a lot of like increase in valuation and growth going forward. So a lot of profitable growth. So the minute that changes, that kind of compresses the whole the kind of whole valuation stack, as it were. So
well, I also think in this environment, what happened as well is in the last, particularly I'd say 5 years, is that valuation is always a function of looking at multiples is one thing, but you're also trying to gauge how much market share these companies are going to take vis-a-vis the incumbents, particularly in sectors like fintech. Like how much is Klarna or BNPLs in general, or alternative credit providers in general, going to take away from financial institutions and traditional lenders and Visa and MasterCard? And so I think it's good to think about it that way. I just think the market probably got a little over its skis in terms of what that pace was going to look like 5, 10, 15 years out, and what the market was willing to pay for that. And I think that's, and so I think that's one thing to consider. I think obviously the valuations the velocity was just incredible over the last 5 to 10 years. We'll see where the market settles. I think the other thing that to learn from the last pandemic and maybe even the GFC and now is that, things turn quickly in either direction, right? Like Sequoia comes out and writes the letter about the pandemic and how it's going to be, it's going to be generational. And then, 3 months later, maybe the strongest, year in venture capital investing starts, and all these big firms make a ton of money, at least on paper, and some manage to exit, and get some money out. But I think, things kind of went from very somber to very strong, very, very quickly. I think in the other direction, it's probably going to go kind of, the pendulum is going to swing extremely acutely as well. And then you'll find some place where there's equilibrium or where you'll find, some sort of place where the market settles. I was in the US last week talking to, a fairly well-known fintech VC, and they're saying things have gotten so bad in the US where, consumer fintech is now trading at like kind of 2 or 3x revenue. And you're kind of thinking like, that's just, like where we were kind of, and we're not talking where we were 12 months ago. We're talking about where we were 4 months ago, right? Like companies were still raising off the back of projected growth, projected capture of market share in January and February. And we're just barely in July. So things moved very, very quickly. And obviously geopolitical things happened and kind of spurred that on a little bit. But I think, overall it's like, just wait, just kind of wait it out. I agree with Shane. There's a new frame of reference, but I think it's also like things move aggressively, particularly in our world, in either direction. And I think the main takeaway is to kind of stay calm and focus on, I think great businesses with great founders in big markets are going to do well. I think regardless, and I think it's concentrating capital on those companies as opposed to being a little bit more broader with what you're looking at in terms of deployment.
Yeah, I mean, just a small addition to that, which is that, great companies, great founders building great companies, solving big problems is definitely, they'll always attract capital and they'll do well. I think there have been a lot of businesses using that kind of, that may not be great companies, but that are, chasing that growth at any cost, metric that Shane was alluding to. And I think a lot of people get the kind of lessons of that wrong. So there's this idea that like big companies like Facebook, Google, these businesses and many other like of the large tech businesses that are hugely profitable today, basically printing money, 15, 20 years ago, or when they started out, they went in this kind of J curve, and the rationale was, I'll burn money to gain market share. But then there was a clear idea of them building a category and building a new industry and a path or an idea towards profitability. I worry that there's a good subset of the market where, the idea of like how to get to profitability and how to get to being very profitable in like Google or Facebook, etc. That's never really kind of thought through. It's just like scale, and then you have a 2% gross margin. And it's like, well, what's that going to do like in the long run? So I feel that's going to get hit a bit, and that might be natural because it is taking it back to that function of like, what are these businesses delivering in profits for their what's the promise of these businesses delivering in reality as profits in the future for their shareholders. So I think that the reframing towards that is a good thing. I think there will be some casualties of this, which might not be a bad thing. I mean, there's some value in creative destruction related to this, but that's just kind of generally like our take on it. But we'll see. Like to your point, Sunil, I think things can bounce back very quick as well. Could get a much better than anticipated inflation report, and the Fed says, "Oh, we're not going to do any rate hikes," and could happen, right? Could change very quickly in an instant.
Yeah, I think we all agreed that we have seen the big changes on the more mature market, more specifically the US market. And you mentioned, Khaled, the lag between the US market and more mature market and the MENA market. So does those changes already impacted us, or is it on the way? Do you see it when in the last few months, does the valuation changes or not yet? Shane is laughing,
I would say not enough.
so he has a good answer.
Look, guys, I love to talk about this openly in this type of like a forum, because the more we openly talk about it, I think all of us will be healthier. So I personally, so like we as a Shuruk, as one of the leading seed stage, early stage funds, we look at like thousands of companies every year, right? And really like probably the top of the top across the whole Middle East, North Africa, and Pakistan. So we really have a good, it's a diverse benchmark. I do not think the region's valuations have calibrated, recalibrated enough to the extent that they should have, for a variety of reasons. If I start with fundamentals, our region fundamentals, I actually believe we're still much healthier than a lot of people might worry that we think we are, right? So like globally last year, if I say that there were $660 billion VC tech ecosystem was invested, our region was only about a little bit less than 3 billion, as we know from the Magnet report. So that's about 0.3%. Look, our region's contribution to the global GDP and economy is way more than that. So I think we're still playing the catch up. So I can argue that for a good, like a bottoms up build, we're still playing catch up. So we might not see enough. Sorry, I actually might have something. Like, so we might not see enough recalibration. However, what we, especially the investor, I don't think it's only the founders, also investors need to do a better job is to tie this back. We should really be backing companies who are building strong long-term defensible mode with like a healthy unit economics, good retention rate of the customers. But it's so easy to mask that if you can raise money and just buy the customers. It's so easy to overinvest in the market and whatnot. So like it's not clear who actually is building defensible mode or whatnot. And so far, the last many years, especially in the Middle East, right, the valuations were like going above and beyond because of the competition among the VCs. The founders treat this, they raise a lot more than what they should have. They raise a lot more than what they actually need just for the sake of raising because they had access to the capital. I think all of that is changing with all these discussions, but not early enough. And hopefully we're calibrating that very soon, left and right. And I think more discussions like this will get us there.
Yeah. Yeah, I think it's coming. I mean, I think like, yeah, there is two dynamics or three dynamics happening in our market at the same time. One is, oil prices are high, which means, regional, particularly GCC governments are, they have a positive fiscal balance and they're investing, right? They are investing whether directly, indirectly, you see it where they're moving away from subsidies and moving more towards investing, which creates a positive momentum for us. The second dynamic is that, yes, as Shane mentioned, like we're an evolving market, so we're still, whatever frothiness there was, it pales in comparison to what was going on in the US. But then the negative dynamic is that, usually this kind of contagion kind of comes here, and then if there's a global recession in the real world market, in the real economy, then that invariably will lead to some slowdown in oil prices as well, which has a negative feedback loop to us. So we'll see like where it ends out. There are all these issues around oil that are like the oil market that are interesting, no capacity, etc. So, but it'll be interesting to see how that all feeds into the regional ecosystem. So we might be better than most because we have these things, the different dynamics buttressing us. But we're already seeing the valuations kind of coming down in a meaningful way, and I expect that to keep on happening for the next on a multiple basis, right? For the next 3-4 months, unless as Sunil said, there's some major change, and then we're all kind of back to the races again. But yeah, I think like you can tell that we're all a bit positive. I think because as like fund managers who have dry powder, like this is like when you make money basically. But and I think for the founders, it seems like whiplash where the dynamic has shifted very quickly in terms of like who sets the valuation discussion with capital or against capital. So So there's kind of like that's the kind of like dynamic we're working through, at least as well, to make sure that, you know, we kind of fund companies fairly as the valuations come down.
Yeah, I think it, you know, taking valuation aside, which we think there'll be a recalibration. It's already started, and I think it'll hopefully continue to recalibrate further. I do think, you know, net MENA still, you know, MENA long term is still is in a pretty good place. You know, oil price is high in the short to medium term, but also just and this is really, you know, adding to Khalid's point, is that there's just so much white space. We're not a developed market like the US and Europe, where this is going to be deeper and probably, you know, far more acute. I think for us, it's, you're going to have these short-term blips, and you'll have valuation recalibration. I think you'll see a lot of founders leave the market. That was one thing that happened as well, is that, you know, you had a lot of people, you know, leaving jobs to go build startups because of crazy valuations, and it kind of all cycled, and maybe not all of those individuals were well placed to do so. And so you'll have some companies, unfortunately, that will shut down, and you'll have some companies leave the market. But I think all in all, we're in, you know, we're in, you know, the second or third inning of kind of the overall emergence of the tech ecosystem in MENA, and think there's huge opportunity when you think about the size of the market, and particularly as companies now start to navigate moving across borders more efficiently and more effectively than they have, let's say 10 years ago, which is one of the key ingredients for creating, you know, great companies, unicorns in the region. And so we're already starting to see it in our portfolio and everyone else's. So I think net, you know, I think MENA will come out of this in the long term stronger and in a better place.
So team, if I may, I just want to quantify always and give as much data, because by being an international VC, and I think all of us, we talk to many of our peers in the West to the East, want to quantify a few things, right? I think I don't know how many people really know Middle East, our seed rounds and Series A rounds, right, are actually surprisingly larger than a lot of the rounds in the US and Asia. Like, again, the caveat here is our seed round, many people might say different rounds in other regions. So like,
okay, Sunil, so speaking of what Shane mentioned about the valuation for the seed and A, the region is higher than the West and also the East. Is this because of the availability of capital, because we have too much cash in the market, or is there any other reasons for this massive increase, as you mentioned, Shane?
Yeah, I think it's a function of a few things. I think it's also a function of you know, how early we are in our ecosystem. I think in the US, it's easier to slot companies into stages, because frankly, investors have been doing it for a long time. Founders are more attuned to like what a pre-seed is, what a seed is, what a, you know, like they're just bucketed more correctly, because you just have more data in the US, because you've got years and years and years of kind of investment track record. I think in MENA, we're still finding our feet, because you know, the companies have been built a little bit differently, right? Like I think in the US, there's a very structured trajectory of how a company goes from kind of initial money in to kind of where they're, you know, where they're kind of a growth stage company. I think in MENA, I think, you know, we're classifying them a little bit differently, and it's just a function of what you're calling it. You know, you've got rounds that are being announced recently, you know, that are called A's, but let's face it, like the round sizes are really kind of Series B rounds in any normal market. It just happens to be, you know, it happens to be a specific company's first, you know, first big round. And so it's kind of like, well, we're calling it an A because, you know, they've managed to kind of grow super efficiently, which is a good thing actually, over the start, you know, like it just really, it's harder to say. I think one dynamic that's a little bit different in MENA now is that you've got kind of large institutional, you know, asset allocators that have started to kind of come into rounds, you know, whether through co-investment earlier than perhaps their equivalents would do in, let's say, the US, right? Like you're not going to have large pension funds in the US going into kind of Series A's directly or even seeds directly. You just don't have it. they're just kind of out of that business. They deploy into VC funds. They let their managers do their work, and they'll come in a little bit later. I think here where the goals are different, right? Like developmental capital is looking to kind of like back good founders and create an ecosystem. It's different than CalPERS in the US. Like that's not what they're solving for, right? Like, and so so it's not an apples to apples comparison really. So I think that last part in terms of having large asset allocators, kind of government or government-backed institutions, particularly across the GCC, starting to kind of go in early and do directs alongside funds that they've invested in, to kind of bolster the size of rounds, has led to kind of perhaps that dynamic or kind of from a data standpoint, rounds being bigger. But I also think it's just what, I think it's the kind of youth of the market in terms of how companies have grown. They've gotten from kind of 0 to 1, or 1 to 20 in like a different way. Whereas in the US, it's very regimented. Like, you start here and you raise $1 million, then you go find initial product market fit, then you go out and do another, and you just kind of like, they're bucketed in more precisely. And that'll start to change in the region as well as more maturity develops.
I think on like Shane's point that like seed rounds, early rounds are larger than they are elsewhere in the world. I think agree with everything that Sunil said, and would add that there's also, because we're a nascent market or an emerging market that's kind of growing and developing in the venture space, we have a very large preponderance, relatively speaking, of early stage small funds. So you have a lot of like 20, 30, 40, $50 million funds out there. And then suddenly, as you hit the $100 million mark, that starts decreasing very quickly. And so there isn't yet a kind of, breakout firms, as it were. Instead, there's kind of a large number of investors trying to kind of do different things. And even if you look at later stage rounds, disproportionately, they tend to have a larger number of investors per round than like in other markets, even other emerging markets. And part of the reason for that is there are no large or very few really institutional dedicated pots of capital. Instead, you have like the asset allocators trying to do it themselves, or large families trying to do it themselves. But I think that'll start changing quickly, and you'll have like a shakeup in the venture market, the VC market itself, where you should start emerging like breakout firms that may be focused on stage or multi-stage, right? Like they do in other markets, but then have scale in AUM, have scale in firepower and dry powder. And I think that's still to be seen. And I think what's going to happen in the next couple of years, there's going to be a form of, shake up in the industry, so that you do start having those kind of breakout firms, and then a more natural funding cycle where the seeds get smaller, but then you have more specialization across funding rounds, or firms are able to have multiple funds that look at different stages. So that's kind of, we're just at the beginning of our cycle, so we'll see how that shakes out in the long run. But some of the idiosyncrasies of our market are such that there's a very large number of relatively small funds, and that has its own implications in terms of what the funding rounds look like, and then what happens beyond seed and Series A.
Shane, you mentioned that the valuation here is in the early stage is higher. Is this happen in a very specific sectors, or this is averages on all the sectors?
So I would say almost every sector, but we all know fintech has been, let's say, the king proponent of that. Even here, like I would say, half of our portfolio companies are in fintech. We have always been loving this since 2016, 17. I know Sunil, Khalid also do like that space. And there's no secret sauce that the fintech, especially in our view, fintech infrastructure layer has been one of the most important revolution to happen in our region. So like a fintech has been a big focus for many investors, and that's why they have been driving it. But I would say, Abdullah, across the whole board, and not specific to one country or so, but like each country kind of adding to each other, and like we whole as a region have been really being uplifted, right, in the valuations.
Yeah.
Okay. Khalid, anything to add on that?
Yeah, I mean, just like very simple stuff. I would love to see, I mean, just kind of going a bit of a tangent, like how Some sectors would be affected more than others. Again, back to this idea of huge structural problems like fintech, like the region still for all the stuff that is funded out there, including the GCC, so the GCC plus Egypt, it's like one of the most underbanked places on the planet, right? Even like worse than some parts of sub-Saharan Africa. So like it makes you think. So on some level, the GDP per capita is higher, but then access to credit for SMEs and small companies remains like massively underfunded. And so there are kind of these big solutions that tech can help solve, that I think those will benefit from this type of kind of downturn, because then people really focus on what's a big market, what's an effective business model, what's a big problem that's being solved, and what's being solved in a sustainable way. So I think some sectors, there will be some shakeout in the sectors. I think fintech infrastructure, fintech generally is definitely one for sure. That'll benefit in the long run.
Okay, before moving to the last part of the webinar, Sunil, you mentioned the availability of capital got impacted on the more mature markets, and I read a report that was issued by CP Insight that the global venture funding has declined around 27% quarter on quarter. And as you mentioned, Sequoia Capital and also Y Combinator informed their portfolio companies to extend their runway and enhance their operations to be ready in case conditions get worse. On the other hand, speaking of the lag between the two markets, the recent report about the venture activities in the MENA region issued by Digital Digest showed a massive increase in the venture funding in the first half of 2022 comparing to last year. So do you think funding for both funds and startups will slow down and be more challenging in our region?
Well, I think, and this goes, adding to, I think, Khalid's point in our previous discussion around oil prices in the region. I think in the short to medium term, governments, particularly in the GCC, and particularly those with sophisticated, VC developmental programs like Saudi, for instance, and others. I think there'll be no shortage of capital there, given where oil prices are, and even if there's short-term fluctuations, I think fiscally those markets are going to be in a good place. And so from what we can see, the institutions are doing a good job in terms of continuing to fund VCs in the region as per their mandate. So I think more questions will be asked about where that capital is going, and rightfully so. 2020 and 2021 were just different markets, different times. Like, let's just forget about that. But I think institutions like yourself and others should ask those questions. I think so. But I do think ultimately the money will get to good VCs who've shown kind of track record and ability to deliver returns and back good companies. I think that'll continue for the foreseeable future. You might know better than I, but I also think that VCs are going to be a lot more meticulous. And so I think the funding, the slowdown will the starting point will be the venture capital firms. I think they're going to be more meticulous. I think they'll probably be more concentrated portfolios, putting more capital into companies that they have really high conviction around, and really kind of fit the new frame of reference as kind of like Shane was referring to it in terms of capital efficiency, not growth at all costs, good unit economics, great kind of retention rates, good product market fit, all of that in big markets and companies that can go across MENA. So I think that's where the slowdown will happen, but I think it'll be kind of more around velocity and kind of how many companies those gets to. I think the good companies, will ultimately raise the capital they need to continue to get to where they want to get to. It'll just be a little bit more disjointed than it was in the last few years.
Perfect. Thank you, Sunil. I would like to move to our last part of the webinar, where we would like to hear from all of you, the lessons learned from the previous pandemic, how you handled it, and also recommendations for founders and how should they be prepared to get through tough times. So starting with you, Shane.
There are many points. So in the beginning of a pandemic, and also in the beginning of this macro at least with all of our portfolio companies at Shurok, we really were proactive and spent a significant amount of time with our portfolio companies to do a few things. First, look, because everyone will say lean the cost, I want to go a bit more specific, right? Because if you were spending, let's say, for the lack of comparison, $2 million a month, let's really understand the magnitude of that and why we're spending and how we're spending, right? Because I know there were quite a lot of companies who are actually spending 2 million, perhaps even $4 million a month. And I have to argue that, frankly, unless you're really doing significant amount of GMV, I'm talking about a billion, perhaps we need to assess, are you actually properly spending $50 million a year, right? And there are probably a lot of fat. And if you are spending too much money just as a discount, the promotions, the leakages, just to compete with other players for the hope of gaining a market share, honestly, all of that should be the first ones to go. So like anything on the marketing, on the promotion slash discounts, the leakages, I believe those should have been really slashed by the founders in light of this current macro. If you have not done so, I can say that you're late. So please do focus on it. And then second, also think about your core assets of the people, right? That no one wants to say sorry to the team, but at the end, your fiduciary duty and responsibility as a leader is to take care of the company, right? I believe sometimes, okay, look, all of us, something that I learned as a lesson when I was worked at a PE firm in San Francisco many years ago was we gotta do what's right for the company, and then personally, we gotta do everything I can do to help the people out, right? But like we should not mix that, right? We have to make those tough decisions, frankly, sooner than later. Many investors are okay if you lower your GMV, if you don't grow actually at all right now, but we're not gonna be overly generous if you haven't reduced your burn, especially just because, oh, like I didn't want to destroy my culture, I didn't want to say those unfortunate stuff. We all understand how difficult, and the investors, many good of us, I know Sunny and Hollywood do the same. We're here to work with the founders, work with the team to show them the inspiration, to also explain why it's so difficult. But like right now is not the time to, I think we're not a Red Cross. We have to do what's good for the company, and you have to make those disciplined decisions actually ASAP. Again, if you have not done so, you're late, right? And that might risk the company, because if you have not done so, you're underestimating the significant, the macro circumstances that the globally is going through.
Thank you so much, Sunil.
Yeah, agreed. I think it's, it's when you go back and to be, kind of, I think when you talk about if you start at the pandemic, I think, all of us thought that was going to be something, and then it turned into something completely different, right? Like I think I think there was an initial, reaching out to obviously your entire portfolio, and for us, frankly, when that hit in 2020. We had just started raising for our first fund, so we weren't really, we didn't have a portfolio, at least for regional fintech portfolio yet. So we almost had the benefit of standing back, obviously focusing on raising capital, which was tough at the first couple of months when the pandemic started, but gradually got better for us and everyone. But so I think it was kind of the downturn off the pandemic was so truncated that I think there was a lot of there was a narrative around, oh, our companies, we got to spend a lot of time with them. But like, frankly, you had very few casualties compared to what was actually happening in the world. And really it was back to business, by kind of June 2020. And then, we all saw what's happened over the last couple of years. And so I think it's hard to kind of extrapolate a lot in terms of depth from what happened during the pandemic. I think in theory, we all knew what kind of needed to happen. So now looking at what's going to happen here, which is kind of a real a real kind of macroeconomic situation with real challenges that frankly, most of the founders we're all backing, let's be honest, have not dealt with this environment before. That, you know, most of them haven't dealt with an actual, you know, weren't really even kind of fully into their careers necessarily. Definitely not with most of them in terms of their startups coming off the GFC. So they don't, you know, most of them haven't kind of seen a sharp economic decline and as prolonged as even this might be. And so it's really, you know, and I don't want to date myself, but, you know, like I started my first job, you know, in October 2008. So it's like, you know, like it's just it's just a little bit of different context. So, you know, I think against that backdrop, it's super important, as Shane said, to already have started, you know, like for us, we started having kind of, you know, kind of long conversations with all of our portfolio months ago, to really kind of see where a lot of, and some of them are in different places than others, generally all, you know, all good. But I think it's really kind of, you know, kind of what you're spending on, you know, becoming more capital efficient, really kind of like cutting the fat, in terms of kind of product ideas, but also kind of all of those ingredients of kind of growth chasing. And so I think it's just a matter of staying close, to a lot of these founders who, frankly, it's no fault of their own, that they just don't have the experience. They're too young, to have dealt with something like this before. So it's really important to kind of stay close with them as they kind of try to like sustain and emerge. And for us, we're not, you know, there are a lot of companies that can be methodically, you know, we're calling kind of like methodically aggressive. Like they don't have to kind of be in a holding pattern right now. They have to be, you know, continue to be careful, or be more careful in terms of how they spend their money and where they spend their money. But I think this can actually be an opportunity for them to emerge and actually take market share, you know, when we come out of this, whether that's 6 months, 9 months, 18 months, you know, it's changing every day. I'm not an economist, so you know, I'm not gonna take an educated guess in terms of what that'll look like. But it's having your companies be in a position to emerge aggressively when we kind of get to a better place from a macro standpoint.
Khalid, any advices, recommendation for the founders in this time?
Yeah, I think not much to add, beyond what the guys have said. Maybe just what we've advised our founders is, you know, all of what's mentioned, plus like that they shouldn't get out of the mode of like optimizing for valuation and optimize for runway now, right? Because we don't know, in the uncertainty of the global markets, you know, assume there's no capital or less capital or unattractive capital for the next like 18 months. So make sure that you can go for 18, 24 months, while maintaining good growth, right? Like, so it's just kind of unspooling what is, you know, like new market entry versus like growing in a market you're already in, and being very careful in your capital deployment. So I think those are the big things we're kind of pushing to our founders. You know, spent a lot of time with each of them, thinking about, you know, what's best for the companies. Well, how do you kind of push forward on getting enough capital into the business, not just to weather the storm, but also to win, right? So that you're in a category where if there are competitors, you can rise above them because you are well funded and you're deploying your capital judiciously and effectively. So that's the kind of like big takeaway for us. And I think it's the same as like with the other guys, so with Shane and with Sunil. It's almost like I think we're all pushing in the same direction.
So Abdullah, if I may, just wanted to have a half joke, half serious note. Team, it's okay to be a profitable company, right? I think it's really perfectly fine to be a profitable company. There's no taboo on that. And a lot of our companies actually are profitable and they really exert strength. And this is a great time to think about, if you try, can you actually be profitable? If you can't, right? And if that real reason is because of a scale, I understand it. But not every model, perhaps because of a structure reason, perhaps because of the margin reason, might actually be profitable. Then at what point you should think about how I can solve that. This is the perfect time to actually solve for that, because now investors quickly shifted from revenue to profitability, right? And we're gonna stay here for a while. Like we have to understand, and like the founders and the team, you really need to understand, can you answer that question in a very articulate manner, right? And unfortunately, for many years, that question was never really the central piece, right? However, now it really is, right? And it's just, again, the new norm. Let's quickly recalibrate and make sure we also put that as part of our articulation to the fundraising, if you only talk about GMV, like honestly, you're not gonna do well on the fundraising. All right, I just wanted to make sure I articulate this, really emphasize this point.
Thank you so much, Shane. Thank you, Khalid. Thank you, Sunil, for the great insights. And as highlighted by our panelists, recommendation for the founders that they should not panic and they should focus more on their operational enhancements and extend their runway. Also focuses on the product development rather than unnecessary expenses. And I would like to emphasize that Jada will continue its role being the catalyst of the VCP industry and will continue supporting SMEs in Saudi Arabia through its investment and VCP fund. And with that, I'm trying to be mindful of time, so we'll take one or two questions from the audience. Okay. First question, given the market uncertainty, do you think companies will still consider exiting through IPO or will they shelve their plan for now? Who would like to take that?
You mean in the Middle East or across the globe?
Yes, in the Middle East.
So at least the Middle East, our IPO market so far actually has been quite robust in my view, right? And not only like the recent successes from Saudi tech startups that we all know. Actually, I know like Jada and the whole Saudi regulation has been putting significant focus to even make it even more vibrant. And I can also speak the same for UAE, like the IFC, ADJ, and whatnot. So I actually think now I don't see any real correction on that regard, which is very, very healthy point for the Middle East startups.
Okay, the second question, are you going to see more acquisitions or M&A activities in the near future?
Yeah,
I think so.
definitely.
Sorry, go ahead, Khalid.
Yeah, no, 100%. I think you're already starting to see the larger companies buy smaller companies that fit within a target in a tightening fundraising environment. Like I think you saw Manchon and Dinari Cash being acquired by Kareem. Expect a lot of that kind of stuff to be going on. So those sitting on cash and or much larger kind of acquire companies that fit within much smaller companies that fit within a strategic dimension. I'm sure we'll see more and more of that. Large buyouts, like I'm not sure about that. I think we'll see what happens there. Maybe, but people will be looking for value right now.
So can I add a point here, Abdullah and the team?
Please.
If I may, I want to suggest this is where, frankly, good investors and well-reputed investors and founders working together can make a strong synergy, because not every founder knows how to buy other companies. And many investors, because we come from PE background, we come from investment banking background, we actually can support. Where I think the consolidation is already happening, and all of us, frankly, have been saying for now a few months, if not years, is happening. Where the next step is, can we raise capital on top of that? For example, if there is a rule play, right? That company might not have enough capital on their own. Now, some investors, we can help them raise on top of that thesis to make that happen. Right? I know we have been discussing with a few theses. If we can do that, and not every investor can help you with that. If some investors can help you with those, I believe our region will see another acceleration. Because of that, frankly, we need more of those.
Thank you so much, Shane. Hopefully, more bright future, inshallah, ahead of us. I would like to thank you, our esteemed panelists, Sunil, Shane, and Khalid, for your valuable time. Would like to thank everyone for your attendance. And with that, I would like to end our webinar and wishing you a pleasant night. Thank you so much.
Thank you so much, everyone. Thank you, Abdullah, for having us.
Thank you for having me.
Bye-bye.